the Federal Reserve's efforts to combat inflation have made little progress and may have even regressed. Although there has been some temporary relief due to the initial decline in commodity prices, they are expected to reach new highs, revealing how much ground has been lost because the Fed has not raised interest rates sufficiently to restore inflation to 2%. Additionally, the U.S. government has not cooperated in reducing spending by adopting a contractionary fiscal policy to combat inflation. Instead, deficit spending has increased, adding fuel to inflation despite stronger than expected retail sales. The cause is not a strong consumer buying more, but rather inflation driving prices up. While the consensus estimate was for a 1.7% increase, the actual increase was 3% higher. The estimate for a rise in retail sales in January, excluding vehicles, was 0.7, but the actual increase was 2.3, almost triple the estimate. Additionally, the previous month's number was revised from -1.1 to -0.9. If vehicles and gasoline are excluded, the estimate was for a 0.6 increase, but the actual increase was 2.64 times the estimate. Despite the stronger than expected retail sales numbers, the markets initially reacted negatively before recovering. However, this data does not account for inflation and does not necessarily indicate that consumers are buying more. Rather, they are paying more. This is concerning because people are borrowing more money to make these purchases. Household debt hit a new all-time record high of $16.9 trillion in the fourth quarter of 2022, with an increase of 2.4% or $394 billion in debt during the quarter. Furthermore, credit card debt rose by 6.6% to $986 billion during the quarter, indicating the growing burden of debt on households. The latest figures from the Federal Reserve show that credit card debt rose to a record high of $986 billion in the fourth quarter of 2022. This represents the highest quarterly growth in credit card debt since 1999. Despite receiving stimulus payments, Americans had to use their credit cards to pay for the higher prices caused by inflation, resulting in a 15.2% year-over-year increase in credit card debt. The total amount of credit card debt is likely to have exceeded $1 trillion by now. This surge in credit card debt suggests that the labor market is not as strong as some reports have suggested. As the delinquency rate increases, it will become even more problematic for the economy and lenders who will need to write off bigger losses. The notion that a strong labor market leads to increased confidence in purchasing goods and services on credit contradicts common sense. If the labor market were truly strong, individuals would earn enough to afford their expenses without accumulating debt. With interest rates on the rise, one would expect consumers to be more cautious about taking on additional debt. However, many individuals have no choice but to rely on credit to meet their basic needs due to a weak labor market. A weak labor market is characterized by stagnant wages that do not keep pace with inflation, making it impossible for workers to demand pay raises that surpass the cost of living. In a strong labor market, workers will have the leverage to negotiate higher wages that exceed the rate of inflation. The fact that many workers are forced to accept pay cuts demonstrates the presence of a disguised weak labor market. The rise in credit card debt is evidence of the weak labor market, despite claims of its strength. Furthermore, the Fed's efforts to combat inflation are failing because credit expansion fuels demand and contributes to inflation. The fact that credit card debt has not decreased suggests that interest rates have not risen enough to discourage borrowing. However, it is not the consumers who need to be discouraged from borrowing, but the lenders who need to cut back on credit. Since consumers are already in a position where they have no choice but to borrow, consumers are able to continue spending because they can borrow the money to do so, which fuels demand. However, credit card companies need to tighten up on credit to force consumers to cut back on spending and save their paychecks instead of going deeper into debt. Currently, credit is still plentiful despite rate hikes, and the Fed needs to raise interest rates substantially and perhaps increase reserve requirements for banks to reduce the amount available to loan out to consumers. This would be necessary if the Fed was truly serious about fighting inflation, but it can't risk causing a financial crisis by crashing the economy. The current state of the labor market and the increasing levels of credit card debt are indicative of a weak economy. The fact that consumers are having to rely on credit to make purchases rather than their paychecks is a clear indication of weakness in the labor market. If wages were higher and keeping pace with inflation, then consumers would be able to afford their purchases without going into debt. However, this is not the case, and the rising interest rates are only exacerbating the issue. The Federal Reserve's inability to combat inflation is also contributing to the problem. The expansion of credit is contributing to inflation and increasing consumer demand, which is driving up prices. However, despite the Fed's attempts to raise interest rates, consumers are still borrowing money at alarming rates, leading to a surge in credit card debt. This, in turn, is further fueling demand and inflation. While consumers are able to continue spending by borrowing, lenders must realize that they are not going to get repaid, and cut back on credit to help consumers save their paychecks and reduce their debt. To address this issue, the Fed needs to take more serious action to combat inflation by tightening credit and raising interest rates far more substantially. However, such actions will also lead to a financial crisis and steep recession. Therefore, the Fed is unlikely to win the fight against inflation while preventing a potential economic collapse at the same time. Until the labor market strengthens, wages increase, and inflation is under control, the country will continue to face economic challenges that impact consumers' ability to make ends meet. Many are expecting a Fed pivot, but be careful for what you wish for, because that can lead to hyperinflation. Be sure to subscribe, and thanks for watching.